Picture this. It's you, a few dollars to your name, and the growing realization that piling up savings in your standard bank account isn't going to cut it anymore. Maybe you've heard that investing is how the wealthy grow their money, but to you, the entire concept feels like deciphering a foreign language. Stocks, bonds, index funds, diversification, what does it all mean? And more importantly, how can you, a beginner, start building an investment portfolio without making costly mistakes? Don't worry, you're not alone. In fact, everyone starts exactly where you are, asking questions and searching for clarity. By the end of this video, you'll have a clear roadmap to begin your investment journey and take the first steps toward building a strong, diversified portfolio. First, let's define what an investment portfolio really is. Think of your portfolio as a basket, and inside this basket you place different assets like stocks, bonds, real estate, and mutual funds. Each of these assets represents a piece of your financial future, and together they determine how much risk you're taking on and how much return you might earn over time. Your goal? To find the right mix for you based on your goals, risk tolerance, and time horizon. Let's break it into 3 simple principles. Know yourself, diversify, and start small. Know yourself. This sounds obvious, right? But you'd be surprised how many people skip this step. Before you buy a single stock or mutual fund, you have to ask yourself a few critical questions. What are your financial goals? Do you want to save for retirement 30 years from now? A home purchase in the next 5 years? Maybe it's both. The timeline for when you'll need the money will shape what you invest in. Long-term goals can withstand more risk because you have time to recover from dips in the market. Short-term goals, you'll play it safer. How much risk can you handle? Let's be real, the stock market can be a roller coaster. Are you someone who freaks out at the smallest dip in value? Or can you remain calm while your investments ride the ups and downs? Understanding your risk tolerance is key because taking on more risk than you're comfortable with will trigger panic decisions, and those cost money. Pro tip: if you're not sure where you fall, most online brokerages offer risk assessment quizzes that help determine your investor personality. It's a great place to start. Now that you know yourself, let's move to step 2, diversify. All right, here's a question for you. Have you ever heard someone say, don't put all your eggs in one basket? That's diversification in a nutshell. If you take all your money and invest it in just one company, say Company X, and Company X suddenly goes bankrupt, you've lost everything. But if you spread your money across dozens, even hundreds of companies, industries, and markets, a failure in one place won't sink your entire portfolio. So how do you diversify? Here are the building blocks of a good beginner portfolio. Stocks are shares of ownership in a company. When you buy a stock, you're essentially buying a tiny piece of that business. Stocks are great for growth, but they're also the riskiest component of a portfolio because their value can swing up and down. Think of a bond as a loan you're giving to a government or a company. In exchange, they pay you interest over time. Bonds are much steadier than stocks, but they usually provide lower returns. They act as a safety net in your portfolio, stable and predictable. If you've ever thought, I wouldn't even know which companies to invest in, then index funds and ETFs are for you. These are essentially baskets of stocks or bonds that mirror popular market indexes like the S&P 500. They give you instant diversification because you're investing in hundreds of companies at once. And the best part? They're low cost, making them perfect for beginners. Always keep some cash on hand for emergencies. Think of this as your financial safety cushion. Not too exciting, but extremely useful when life throws curveballs. Here's an example of balance. Say you're in your 20s or 30s with decades ahead to save for retirement. You might build a portfolio that's 80% stocks, 15% bonds, and 5% cash. The heavy stock focus takes advantage of long-term growth while the bonds and cash provide stability. But if you're in your 50s and retirement isn't far off, you'd likely flip those percentages, more bonds, fewer stocks, to lock in gains and reduce risk. Start small and automate. Let's talk money. How much do you think you need to get started? $1,000? $5,000? Actually, you can start with as little as $50, sometimes even less. Online platforms like Robinhood, Fidelity, and Vanguard have made investing more accessible than ever, removing high minimum balances that used to keep beginners out. The most important thing isn't how much you invest, but that you start now. Why? Because of a little magic called compound interest. The earlier you invest, the more time your money has to grow. Let's say you invest $100 a month, starting at age 25. By the time you're 65, that money could grow to over $400,000 based on an average market return of 7%. Wait until you're 35 to start? You'll have just $200,000. The difference is time. Here's one more secret to success. Automate your investments. Set up automatic monthly contributions to your portfolio. This is called dollar cost averaging, and it ensures you're buying assets consistently, whether the market is up, down, or sideways. Over time, it smooths out the bumps and takes the emotion out of investing. Now you might be wondering, what about fees? Taxes? All the fine print? Those are important too, so let's simplify. Keep an eye on expense ratios for index funds or ETFs. An expense ratio is the annual fee charged by the fund, and the lower the better. Anything below 0.5% is considered low cost. Use tax-advantaged accounts like Roth IRAs or 401ks when possible. These accounts help your money grow faster by reducing what you owe the government. A Roth IRA in particular is great for beginners. And lastly, don't overreact to market news. The stock market will have bad days, weeks, even years. Stay focused on the long term. Patience pays off. So there you have it. Know yourself, diversify, and start small. Building a strong investment portfolio isn't about chasing the next big stock or timing the market perfectly. It's about steady, consistent progress. Remember, you're playing the long game here. Investing isn't about getting rich quick. It's about growing wealth over time, making your money work for you, and building a financial future that aligns with your goals. You've got this. Whether you're starting with $50 or $500, you're setting the foundation for something powerful. And with time, patience, and diligence, you'll look back and realize that the hardest part wasn't the process. It was making the decision to start. So here's your challenge. Start today. Take that first step. Your future self will thank you.